Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. Hope you're enjoying your weekend. Bob has dug up a pretty interesting chart here. You're not going to want to miss this one because it has never failed and it's telling us what to expect in the stock market. So we're going to talk about how much we can expect out of this market going forward and kind of a timeline. And so let's dive into this because you're not going to want to miss this.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
All right, Bob. Now this chart at first I was confused at, so I'm going to let you explain it. But it's a pretty interesting chart as far as the dangers that are lurking under the surface here.
Yeah, so Phil, and for those listening, it's really, really, really simple. So when you're an investor, okay, you want to outrun inflation and you want to outrun your cost of capital, okay? And so investors are always looking at, where am I going to put my money for that to occur? Do I keep it in cash? Do I put it in the bond market? Do I put it in precious metals? Do I put it in real estate? And any combination therein. And so what they like to look at, yields. Everything has a yield. The earnings yield is the inverse of the price earnings ratio, for example. The bond yield is the yield you get for your interest on your stock. The cap rate is, the income against the price, so on and so forth. Well, this particular chart, Phil, it shows you that on the long-term basis, stock investors want to earn 2% of risk premium over the 10-year T-bond. Okay. Mm-hmm. And so what you look at then is like, okay, what's the T-bond right now trading at? So I think it's around 5% and or 4.5%. And so you're looking at 6.5%, 7% is what you need to yield in the stock market on a go forward basis. Right now, the stock market is yielding at 3%. Okay, because the PE is so high on the stock market. So over time, risk managers are going to then evaluate where they're going to put their money. And so when you're this far out, it's basically saying we're 55% overvalued in the stock market. And I want to show you something, Phil. If you can move your little cursor on there, if you have a chance, is that if you slide it back to 2020, you see where the red, stalactite moving down reached the blue coming up. That was the 2020 market sell-off. And all that did was bring us back to fair value between the cost of money and the return that you're expecting on that capital. And then immediately inflation took hold and we started to dive down, and then we started to raise interest rates, and it leaves us right now at just about 62% overvalued. Wow. In the stock market right now on a go-forward basis. Now, before I get all bear porny and say we're going to crash, that's likely scenario that we're going to fall, okay? And so you just simply have to look at the last, recessions that we've had, right? Look at 2000, look at 2008. Those are those big red line down in the past. That's the market catching up to the fair value, right? Or catching down in this case. And so we have a long way to go to get to fair value. And there's only a couple ways to get there, right? Either some brave new world comes in and the cash flow from these businesses are such that makes them cheap, which we know is not going to happen, or Jerome Powell is going to lower interest rates, which I think has been the play. And the reason why this market has been holding and holding and holding and holding, they're going to see if he blinks, or price has to come down. And Jerome Powell has been very clear that he's not going to lower interest rates. And in July, in the next 3 weeks, we have another interest rate decision with, I think Phil is at 80% now. People think that he's going to raise another quarter point.
Yeah. Yep.
And when that happens, guys, another thing happens that, and maybe we should create this chart in the future. It's called the toggle. So this is why reverse repo, banks are sitting on all this extra cash that basically they were given in 2020. That's why they have all this reserve money anyway to speculate with, is that the Federal Reserve puts an interest rate out there if they want them to speculate with it or if they want them to keep it on the Federal Reserve's books and they pay them an interest rate. Well, if he raises interest rates again, Janet Yellen may have a hard time selling T-bills at a rate that's attracted to them. And you're going to see that money come away from her and back into the reverse repo markets, Phil. And that would be very bearish because that's what they've been doing too. They've been raiding the reverse repo, which is the reserve money, the piggy bank, if you will, and they're giving it to Yellen. But she may not be able to get that interest rate up high enough to attract those people. So it's going to be really interesting to see.
Yeah, and so that might be where it comes to a head. But even that being said, with the repos absorbing some of her debt issuance, we've seen, and those that have the template have seen, that liquidity is falling off a cliff. And there are times in the stock market's history where liquidity can kind of fade off, net liquidity, but that's because we're in a healthy environment, and all of the recessionary indicators are not printing what they're printing now, right? They're usually in a non-recessionary level of data. And so when we're in the situation where you have QT, there's no more easing, and you're getting this disparity a lot, and you're looking at what's driving this. A lot of it is just what's going on with just derivative hedging, right? And you're essentially getting a series of squeezes. But fundamentally, though, we're there's just a ton of air under this, and it's a very precarious situation that we're in. So, and it's hard to you get repetitive in saying that, right? But when you have the jaws of price going up and liquidity going down, and you have that that divergent jaw formation, right? It usually snaps shut. So either liquidity comes up and price comes down and they meet in the middle, or price is going to correct down here because we're at the same liquidity levels, because fundamentally the market hasn't really changed, right? We're still QT, right? I think stock valuations are way overheated. So similar to what we saw in periods last year, and yet here we are with the about 700 plus points now over fair value. So that could come off quickly like that. It's just a matter of, I think the consensus is that once we got past the holiday and OPEX, right? So the quarterly window dressing, and then you always have this kind of holiday levitation. If you guys focus on 3-day weekends and things like that, you kind of notice that very rarely are you going to see any kind of negative price action as you kind of float into the holiday. So now that that's out of the way, it's okay, big OPEX is done, quarterly OPEX is done, holiday float's done. So now we're looking for Wednesday, Thursday, Friday into next week to see if there's any reaction now, and these derivative flows are gone. We see gravity start to take hold.
Yeah, and there's a guy named Shem Croissant. We call him Jam Croissant. He had a really, really interesting podcast this Friday that basically is explaining what's happening is that you have structured funds are selling volatility at unprecedented levels, even higher than what happened before the 2017 Volmageddon, which means that there was a massive snapback higher in the VIX. And he says at some point, because it's a zero-sum game, at some point, those trades have to come off, Phil. And when those trades even slow down, it reverses polarity of the markets because they realize that they're over a cliff and they have nobody to pawn off the risk to anymore. It basically is a Ponzi style situation where it only works if you can keep increasing the intensity of the move, right, to be able to draw more people in this case, draw more people into the market through forced buying because of short covering. And so that's playing itself out here really, really hard. And that really happened from January on. There was a huge amount of short interest. Vol wasn't overly it had a lot of room for them to do what's called supply for this move. But, we're kind of at the end of it. The only problem all of us has is you just don't know the day of reckoning. Right. So, basically you're wrong until you're really, really, really right. And the key then is if you're playing it that way, you have to have the staying power to do it. If you're long, like I'm net long the market, my job right now is to position myself for that move down. So I have to slowly manipulate our portfolio so that we don't take a big hit, because this would be an asymmetric move downfill. It's not going to be like, oh, we're going to just drift down. There's going to be some sharp moves here. They're going to catch a lot of people off guard. And so really the key now is you got to look at Wednesday. I think we look at Friday's unemployment report. That's a tell. And then we have OPEX, which is, basically the 21st, and then it's the 26th. So there's a lot of landmines here in the market. And look, the only thing really going up, they measured it. The top 7 stocks are the move in general. That is the move in the market. So if you own none of those top 7, you're like, what rally are you talking about? You referring to, sir? Because we're fairly flat. And if you own just the top 7, you're like, you guys are a bunch of idiots. This market's going sky high, and then, those guys correct back down. So I thought I'd just share that with you, which my positioning is still the same. I'm short tech, long energy, and I think that's the way I'm going to stay throughout the year. I'm going to nibble on things in and out, but I think that's the play that's going to pay.
Yep. All right, Bob. Well, thanks for showing us the disparity there and really how far down this market can reach before really getting to fundamental fair value here. Guys, let us know your thoughts on this, and we will see you on Wednesday when we come back after the holiday. So thanks for watching. Please hit like and subscribe. Thanks, Bob, and we'll see you guys on the next video. Take care. Bye-bye.
Trade Genius.